Hello students, welcome to this additional explanation. This is quite a good question and it covers investment property as well as transfers between PPE and investment property, and then it also covers general loans. So this is quite a good question. I want us to read together. I'm not particularly sure how I should pronounce the name of this question. So instead of butchering it, I will just call it T Limited, right? So it says T Pty Limited carries on business and occasionally sells property as part of their business activities. Accounting policy and other information are as follows. Then they tell us here that the business uses the revaluation model to value land and buildings by evaluating the asset at the end of the financial year in terms of the net replacement value method. Land and buildings are depreciated on a straight line basis. In the second note, we are told that investment property is measured by applying the fair value model. Then on 1 January 2015, they have given us a summary. The investment properties, there's a question mark. Then they've given us land and buildings, plot 1,600 at 15 million, and then there's some retained earnings and revaluation surpluses that they've added there. In the additional notes, they have now particularly talked about the main types of property that they own, which is plot 1,400, plot 1,500, and then plot 1,600. In the additional notes, they start by talking about plot 1,400, and they say that it is in Cape Town and that it was acquired on 30 June 2014 for 12 million and had a fair value of 16 million on the 31st of December 2014. The property was correctly classified as investment property, and since acquisition it has been leased to Old Mutual at a monthly rental of 20,000 Rand per month. Then they say on 30 June 2015, the property was vacated by Old Mutual and it was to be used by T Limited as their own head office. The company moved into the premises on 30 June 2015. On this date, the property had a fair value of 16 million and a remaining useful life of 10 years with no residual value. So this is very important information. If we just read the sentence, and I just need students to take very careful notice of this. And this is when they talk about the remaining useful life. Please do note that there is a difference between a remaining useful life and a total useful life. A total useful life is the life that is determined on the day that we acquire this asset. So a total useful life for a building can typically be between 20 and 30 years. So that's the whole total life for which this property can be used. A remaining useful life means it's the remaining time for which it can still be used. So let's say that the property has a 30-year lifespan and the remaining useful life is 10 years. That means that we've already used this property for 20 years. So it's very important to read carefully whether they've given you the remaining useful life or the total useful life. Because if the remaining useful life is given, the question is easy and you can just use the remaining life given. But if they've given you the total useful life, it's your responsibility to calculate the remaining useful life by applying your calculations and seeing what is the total useful life and minusing the time for which this asset has been in use. In the second note, they refer to plot 1,500 in Cape Town, and they say that this was constructed during the year ended 31st December 2013. T Limited had the following general borrowings available. They had a bank overdraft with 15 million at an interest rate of 10% per year. On 1 March 2013, of course, 1 March is very important because once we follow the steps of the general loan calculation, we need to calculate the loan in proportion to the months in the year. So the date's very important. Then they also say that there's a general loan worth 15 million at a simple interest rate of 9% on 1 May 2013. The construction commenced on 1 May 2013 and the first progress payment worth 5 million was paid on the same day. The second payment was made on 1 June 2013 and it was worth 10 million. And then the third payment was made on the 1st of September 2013 worth another 5 million. The property was ready for use on 1 September 2013 and immediately rented out to a third party at a rental of 30,000 Rand per month. Rental escalates by 20% per year on 1 February. On 31st December 2015, the property was disposed of for an amount of 27 million Rand in cash. The fair value on this date was 26 million. So this is very interesting, plot 1500. We have an instance where we have investment property, it's being constructed. We construct it through funding it through a general loan. Then once it's been constructed, we rent it out, we collect rental, and then we decide by the end of the year that we would rather dispose of it. So there's a lot of things happening just in that little bit of a paragraph. So sometimes one would expect for a question to be very difficult when someone gives you a very long question. But I find that this is not really true. Once you have a long question, like many pages that you have to read, it might be a lot of reading. However, when it's so long, a lot of information is given. Something that is nice about this second additional note is that a lot of things are happening and they are described in very short paragraphs. So there's a lot of calculations that you have to do. So the lesser information is given, actually the harder the question is. Then in note number 3, there's land and buildings. They say land and buildings are situated on plot 1600 in Johannesburg. The property was acquired on 30 June 2014 for 12 million. And the net replacement value of the property on the 31st of December 2014 amounted to 15 million. The property was used as the head office of T Limited until it was vacated on 30 June 2015. The net replacement value of the property on this date amounted to 16 million. The total useful life, so this is very important to read, total useful life, right? Is 25 years, and on 1 July 2015 the property was leased to Sitole Limited at a monthly rental of 15,000. Then they also say this should actually be the fourth note, I believe. Yes, we have a bit of a numbering issue. Let us just correct it. And in this final fourth additional note, we are told that the fair values of the properties on the 31st of December 2015 was 17 million each, and this was for plot 1400 and plot 1600, right? So now, in the required part, we are asked in required number 1 to record the general journal entries of plot 1400 for the year ended 31st December 2015. Then in note number 2 or required number 2, we are asked to do the general journal entries for plot 1500 for the year ended 31st December 2013. And then in the third required part, they ask us to record the general journal entries of plot 1000. This should read 1600 of T Limited for the year ended 31st December 2015. All right, great. So let's see. We're going to start with the first required part as it relates to plot 1400. So with plot 1400, we purchased it for 12 million. Then it was worth 16 million and it was classified as investment property. So it went from investment property to PPE. And thus we need to apply the necessary steps to reclassify plot 1400. So I'm just going to open my spreadsheet. So for required number 1, we are going to go and look at plot 1400. And this means that we go from investment property to PPE. So what are the steps there? So when we do a reclassification and investment property becomes PPE, we say that there are steps, the steps are as follows. In the first step, we need to do a fair value adjustment on the date that there is a change in intention. Then we need to reclassify it, so take it out of investment property and book it to PPE. And then in the third step, we need to treat it as PPE, so it needs to be depreciated. We need to measure a revaluation surplus. Right, so let's start. The first step is normally to go and look at your fair value adjustment on the date that the intention changes. If I look at this question, the date on which their intention changed was 30 June 2015. So on this date, it ceases to be investment property. And if I look at this fair value on that date, they say on this date, which is 30 June, it's worth 16 million. But it was also worth 16 million already at the beginning of the year, because we are currently in the financial year, 1 January 2015 to 31st December 2015, because that is what the required part requires of us to do. So on 1 January 2015, the fair value would have been the same as on 31st December 2014, because we don't account for a single year, or a single day, I beg your pardon. We do account for a year. And it was already worth 16 million. So because it's worth 16 million at the beginning of the year, and on the date of the change of intention, it's worth 16 million, there's no fair value adjustment to account for. If it had been a different figure, not 16 million as at the beginning of the year, we had to measure a fair value adjustment. So we do not have to measure a fair value adjustment. We simply then have to apply the second step where we move it from investment property to PPE. In that journal entry, we're going to say PPE increases. So I'm just going to call it PPE. And I've noticed in this question, they call it land and buildings, but I'm just going to say PPE plot 1,400, and then I'm going to take it out of investment property, which was also plot 1,400. Right. And the value on the date of change in intention, that date was the 30th of June 2015. On the date that we changed the intention, it's worth 16 million. So we take 16 million out of investment property and we move it to PPE. Great. Thereafter, it's now PPE and we will reach our year end, right? At year end, this would be the 31st of December in accordance with the required part. We need to go and measure two things on the newly classified or reclassified PPE. And that is that we need to go and calculate depreciation. So I'm going to debit the depreciation. I'm going to credit the accumulated depreciation. And now I need to go and measure the depreciation on this asset. So when we put it into PPE, it was worth 16 million. And we are told that the remaining useful life is 10 years. So we can use the 10 as is. They've already calculated the remaining life for us. And then it's reclassified on the 30th of June, which means it was PPE and we were able to depreciate it as PPE in July, August, September, October, November, and December, which is 6 months. So I'm going to say that's times 6 out of 12. Right, in doing that calculation, I get to a depreciation of a total of 800,000 Rand. Then, if we go back to our question, you will observe let me just sort out my technology. There we go. So you will observe that they have given us a fair value at year end. If we scroll down, they say the fair value of plot 1,400 was 17 million on the 31st of December 2015. And they also say that if it is PPE, right, if it is land and buildings, then it is classified or classified as land and buildings. Then we need to use the revaluation model and the net replacement value method, which is the accumulated depreciation elimination method. So here we know it being PPE now, we have to go and calculate our revaluation surplus. So in order to do this, we're going to take out the accumulated depreciation out of this account that we've just measured, right? So I'm going to say the accumulated depreciation needs to be taken out with a debit entry because previously we have credited it. And that was 800,000. And that needs to be paid off against PPE plot 1,400. Right, thereafter we need to go and measure our revaluation. The first thing we need to do is we need to get to the carry value of the asset. So everybody would understand that this is the only accumulated depreciation I can take out of this account because we've measured accumulated depreciation for 6 months. And that is the only time for which this plot has been PPE. So there will be no other accumulated depreciation to eliminate. In order to calculate the revaluation, we're going to say, what is now the value of this plot 1,400? Well, if we look at the cost, or sometimes it's called the gross carry value, because, or the gross carry amount, because it's not particularly the cost, but it's considered the cost, quote unquote, for the time at which the transfer happens. So that was 16 million. Then we had some accumulated depreciation, which is 800,000. So that left us with a carry amount of the difference between the two, which is 1,520, 1,520,000. Right. Now, what is the fair value or the net replacement value on the last day of December? I believe it's given to us as 17 million. So what is the difference there? It's definitely increasing because the fair value is more than the carry amount. So we have a surplus. And the surplus is then the difference between the fair value and the carry amount or the carry value. And that gives us 1.8 million. In this instance, I'm going to say I increase my PPE plot 1,400 and I'm going to book it against the revaluation surplus. And the amount that we've calculated was 1.8 million. Right, so I'm just putting this calculation in a bubble. Right, there we go. So then the one last thing that we should not forget is that there's some rental. We collected rental for this property for 6 months. So it can be bank or debtor, and it's going to be rental income. If I can ever spell correctly. Going back to the question, you would find that the rental income is 20,000 Rand per month. And during the year ended 31st December, we had it be investment property for January, February, March, April, May, and June. It was investment property for 6 months. And during this 6 months, we were able to collect rental. So it's going to be 20,000 times by 6. Right, there we go. And there we have accounted for all possibilities as it relates to plot 1,400 for the year ended 31st December 2015.